Welcome back. In this chapter, we're going to look at Theta. So let me adjust my screens. I'll customize it to just show Theta and the prices of the options. So I'm going to put the last traded price and I'm going to put Theta. Okay, there we go. So this is again the spiders. We're using the spiders as our example, and as usual we'll start looking with the May series options. It's got 60 days to expiry, and the 141 calls and the 141 puts are the at the money options because the spider closed today at $140.85. So that's where the spiders are, and our at the money calls and puts are listed at the 141 strike. Okay, so theta is the amount of time decay that an option will undergo on a daily basis. So here we can see theta listed as one of our columns, and in both the cases of the calls as well as the puts, the concept of theta is the same. Theta is always represented as a negative number because that value gets subtracted from the value of the option on a daily basis. So theta is always a negative number, and if you are a buyer of options, theta, you have a negative theta position, and if you're a seller of options, you have a positive theta position. We'll get into all of that later, but right now you can see that theta is 3 cents for both the at the money call as well as the at the money put. And the concept is the same whether it's the calls or puts. So again, let's just focus on the calls and understand the concepts behind theta, and the same concepts can be transferred or translated directly when you look at puts as well. We're looking at the May series, and when we did the course on time decay, we saw that as you go out further into time, the time decay is less, and as you approach expiry, time decay becomes more and more. And exactly in that course, what we did was we looked at the option prices themselves. We took in the money, at the money, and out of the money options, and then we ran it down from the May series to the April series to the March series. But how exactly those option prices were reducing, in what kind of a formula was it reducing, was not clear because we were just looking at the option prices. In this chapter, we're looking at theta. Theta tells you how much the option is going to lose value on a daily basis. And in this case, in the May series, it's losing about 3 cents per day. So now the next thing to do is let's look at April and see what happens to the options. Again, it's losing only 3 cents a day in April, but like I said, these are rounded off to 2 decimal places, and therefore it's hard to, and especially because the spider trades in single dollar strike prices. So if you look at these strike prices here, they're all $1, so they're very close to each other. Perhaps you can see a better example of theta at work if we looked at Apple. Let's just look at Apple and see what's going on here. So again, Apple, let's close out all the options. This is what the Apple series looks like, and let's go to the May series and see what Apple's theta is. There you go. So now you see Apple's theta for the 600. Apple closed at 601 today, so the 600 call, it would be the closest to the money, closest at the money option, and that's traded, last traded price was $37.55. Now if you look at the theta, this option is going to lose 29 cents in value today, and this is the May series. So the next thing we need to do is to see what this theta value is in the April series. Now you can see the difference. If you look at the same 600 call, in April these options are losing 37 cents a day. So if we go back to our May, and this is what we did in the course on time decay. We looked at the option prices and we said, okay, it reduced from $37.55 to $27 in the next month. And we said, okay, that's a loss of about 25%. But we didn't know how that 25% was lost. And this tells you how it was lost. When in the May, when you have 60 days left, this option is losing about 29 cents a day. But by the time you come to 32 days left for expiry, this option is losing about 37 cents a day. So between 60 days and 32 days, the rate of time decay has gone from 29 cents a day to 37 cents a day. So that's about 8 cents difference over a period of 30 days. You can sort of conceptualize how this rate of time decay is also increasing. Now, if we look at the March weekly options, which have 4 days to expiry, let's see what the theta looks like in that series for the at the money options. This is the at the money. Now you look, your theta is 81 cents a day. So obviously the speed of time decay has increased dramatically. And you're going to see that because there's only 4 days left to expiry. And if any option is out of the money, it's going to lose all its extrinsic value. These are all options that are out of the money. The 600 call is not technically out of the money because Apple is already at 601. So it is $1.10 in the money. However, the option price is $10.75. So it does have like $9.60 of extrinsic value. And that value will get destroyed over the next 4 days if Apple remains at the same price. So today you're going to see that this time decay, the theta value is 81 cents. Tomorrow it could be $1.50. Day after it could be $3 or $4. And the final day could be about $5. So because if Apple doesn't move, then this $9.60 will get destroyed over the next 4 days. Of course, that's not going to happen because Apple is going to move. In fact, today it seems like Apple had a blockbuster day. I think the iPad 3s are doing very well. So Apple's gone up by $15 today. So it's had a great day, and Apple can move quite a bit. But if we just assume that Apple does not move, then $9.60 will have to get destroyed over the next 4 days. And obviously that's not going to happen in equal portions. It's tomorrow it's going to be maybe $1.50, then day after it's going to be perhaps $3 and things like that. So that's how theta will work. And the important thing about theta is that if you're a buyer of options, theta is hurting you. And if you're a seller of options, theta is benefiting you. And in fact, time decay and theta is, in my opinion, the equalizer between a buyer's and a seller's risk and reward profile. If we recall that we always felt that the buyer's risk and reward was skewed in their favor, but that's not the case. In fact, sellers do get quite an edge with time decay, and that actually equalizes the situation between the buyer and the seller. Finally, one last thought on theta. You might be wondering exactly when does this theta affect these options? So the market trades between 9:30 a.m. Eastern Time and 4 o'clock Eastern Time. And options trade only in that window. You can't trade options after 4 o'clock. Some index options trade till 4:15, but most of the stocks and ETFs and all of that, they trade only till 4 o'clock. So that's about a 6.5 hours of trading. And so if you looked at the entire day of 24 hours, you have 6.5 hours of trading, and the balance, the majority of the time, there is no trading going on. So most of the theta decay happens after trading hours. However, if this option was going to lose 81 cents today, they probably shaved off a small part of it, perhaps 20 cents or 25 cents in the last half an hour or 1 hour of trading. The market makers will do that because they know the day is coming to an end, and they will try to shave off some theta decay before the market closes. Where this becomes really important is the weekends, because weekends are 2 days entire there's no market, and then from Friday afternoon until Monday morning there's no trading going on in all these stocks and ETFs, and certainly in the options market. So theta decay over the weekend can be quite significant. You have to understand that this 81 cents or 25 cents, whatever we are looking at, that is a decay on a daily basis. Whether it's a weekday or a weekend day, it doesn't matter. Every day it's going to lose that amount of value. So if you had sold an option on Friday afternoon and you come back on Monday morning, and if the stock has not moved, you're going to see some theta decay benefit there, because the weekend has transpired and you're going to see time decay over the weekend. However, market makers also know this, so they know people want to take positions on Friday and then come back on Monday and close them and just capture the time decay value. So on Fridays especially, they will mark the time decay off perhaps by about 1 o'clock Eastern time. I've noticed that option prices do go down after 1 o'clock on Fridays. So if you are planning to take a position like that and capture some time decay over the weekend, I would suggest that you either do it on Thursday evening or early on Friday morning, before the market makers start to shave off some amount of option price for the weekend. And if you have 3-day weekends and 4-day weekends, it's a great time to capture some time decay, but you should position yourself before the final few hours, because market makers are also smart. They know that people are going to do these things. So I would take up a position perhaps a couple of days before that and take advantage of the long weekends, the 3-day weekends or the 4-day weekends. So that's as far as time decay is concerned. Time decay is a fantastic concept. If you're new to options, you should first get familiar with buying options. But when you buy options, time decay is against you, but that's okay. Your risk is less, and you need to understand how this options market works. And to understand that, there's no better way to understand it than by buying a call or buying a put. And you understand that whole buy cycle first, and then you move to the sell cycle. Selling is a very viable option, and I can tell you that right now. In fact, all my strategies are mostly 95%, 98% are all selling strategies because of time decay. You can construct various strategies that are way out of the money, and you can produce regular monthly income based on time decay. So I'll leave this chapter with that thought, and the next course is going to be trading. So we've finished with the theory, and congratulations again. This chapter on Greeks is over. It was divided into 5 chapters. One was on the Greeks, and then we had 4 chapters on each of the Greeks themselves. So in the next course, which is buying and selling calls and puts, we're going to look at real trades. We'll put the trades on. We'll look at all 4 Greeks in tandem. So because that's the only way options will work. These Greeks don't work on their own. They all work together. So you have to get a collective picture of how the Greeks are impacting your positions. And that's the challenge, but that's the fun also. And so we'll get into that in the next course. So I hope to see you there. If you have any questions, please email me at info@hackertrading.com. But I'll see you in the next course. Thank you very much.